We often hear that phrase, time is money, don't we?
We certainly do.
But when you think about money itself, does time, well, change what it's actually worth?
Ah, yes, absolutely. And that's really the heart of what we're exploring today. So a core idea called the time value of money.
Okay, the time value of money. Let's break that down. So the basic idea, as I understand it, is that money you have right now, well, it's worth more than the exact same amount of money if you get it later on.
Precisely. That's the fundamental concept. It sounds simple, but it has big implications.
So why is that? Why is having, say, $100 today better than getting $100 a year from now?
Well, there are a few key reasons, really. The first one is about what you could do with that money today.
Yeah.
You could perhaps put it somewhere where it earns a little extra for you, couldn't you? Maybe a savings account that pays interest.
Ah, right. So it could grow.
Exactly. It has earning potential. If you don't have the money now, you miss out on that chance to make it grow. We sometimes call that an opportunity cost.
The opportunity you lose by not having it now? Makes sense.
What else? Then there's inflation. You know how prices for things tend to go up over time.
Yeah, like groceries or bus fares costing a bit more each year.
That's it. So $100 in the future might actually buy you less stuff than $100 today can. Its purchasing power goes down.
So the same amount feels like less later on. Got it.
And there's one more thing, really. It's about certainty.
Certainty.
Well, a promise of money in the future. It isn't always a 100% guarantee, is it? Things can happen, plans might change.
True.
Having the money in your hand today is certain. You've got it. Getting it later always has that little bit of, well, uncertainty attached.
Okay, so it's about the potential to earn more, the fact that prices go up, and just the certainty of having it now.
You've got it. It's a bit like that old saying, isn't it? A bird in the hand is worth two in the bush.
Ha, yes. I suppose it is, in a financial sense.
Yeah, this leads us to a couple of key terms. The money you have today, its value now, we call that the present value.
Present value, right.
And what that money could grow into in the future, or thinking about a future amount's worth today, that relates to future value.
Okay, present value and future value. Could we use a simple example, like with, say, $100?
Perfect. Imagine you have $100 right now. Let's say you could put it somewhere safe that earns you perhaps 10% over a year, just as an easy number.
Okay. 10% on $100, that's $10 extra.
Exactly. So after 1 year, your $100 will become $110. So we could say the future value of your $100 today is $110 in 1 year's time, assuming that 10% growth.
Right. So if someone offered you $100 today or $100 in a year, well, you'd take it today, obviously.
You absolutely would, because you could turn it into $110 by next year yourself.
Okay. What if the choice was $100 today or $110 a year?
Now that's interesting, isn't it? If you know you could definitely make that 10% return on the $100 today.
Then it becomes $110 anyway.
Precisely. So in that specific case, getting $100 today is effectively the same as getting $110 in a year. The $110 promised in the future has a present value of $100 today, given that 10% rate.
I see. So you work backwards from the future amount to see what it's worth now.
That's the essence of it. And, over longer periods, even small amounts earned can start to earn their own returns. It starts to build up faster.
Right. That sort of compounding effect people mention sometimes.
Yes, though we won't dive deep into that today. The key thing is understanding that money's value is tied to when you receive it.
Which really tackles a common misunderstanding, doesn't it? That $100 is always $100, no matter when.
Exactly. It's just not the case. $100 today is almost certainly not the same in terms of what it can do or what it can buy as $100 5 years from now.
So a simple takeaway then, when you're faced with choices about money now versus money later.
Yeah, you need to think about that time element. Ask yourself,
Right.
What could I do with this money if I had it sooner? Could it earn something? Could having it now save me from costs later, perhaps?
So it's about comparing apples with apples by bringing everything back to its value at a single point in time, usually today.
That's a great way to put it. Understanding this time value helps you compare options properly. It helps you make, hopefully, smarter choices about when it's best for the money to actually be in your hands.
So next time you have a choice involving money over time, don't just look at the amounts. Ask yourself, what's the value of the when?
Absolutely. It's a really useful way to think about financial decisions, big or small.
Well, hopefully this has been a helpful deep dive for you listening.
And if you found it useful, maybe give it a like or perhaps share with a friend who might benefit from thinking about the time value of money too.